There was this phase of high volatility. These tariffs impacted our trade a lot. Around $180 billion were wiped out from the India market. Donald Trump wants to impose tariffs on everything. We are again caught up in this trade war. Hello everyone. So a lot of events happened in the market over the past couple of weeks. A great budget, rate cuts, many other positive news, but still the market seems to be struggling and there seems to be a persistent volatility. Now let's try to understand why that is happening. The primary reason for this volatility is the trade war that is being waged by Donald Trump against different nations, especially China, which is tariffs being imposed on imports coming to the US and retaliatory tariffs being imposed by the opposing countries on exports coming out of the US. That is disrupting global trade. It will cause an impact on manufacturing, on inflation, and many other things. And that is the primary reason which is causing this fear among investors. This phenomena is nothing new. Many of our investors I know have entered the market recently, but a trade war was actually waged by Donald Trump in 2018 around June and July against China. This continued till 2020 January. Just before COVID, the trade war ended and there was this phase of high volatility, persistent volatility in the market before COVID, which was the trade war period. So what we'll try to do today is try to learn some lessons from that period, what worked, what happened in the market, and how we can position ourselves to take advantage of the volatility that happened in the market around that time. So we'll start by recapping the 2018 trade war. 2018, I actually used to work in the European market and I saw the pain firsthand. We saw deep corrections in the FTSE index, in the S&P index that caused a lot of upheaval. Even the Indian market was quite volatile. So this started in 2018 where Donald Trump first imposed tariffs against solar panels and washing machines coming from China. And then over the course of these 1.5 years, he imposed the tariff 5 times against China. And during this period, China also imposed retaliatory tariffs against the United States. India was also impacted primarily because of the tariffs imposed on steel and aluminium. India exports a lot of steel and aluminium and these tariffs impacted our trade a lot. So India actually went to the WTO, the World Trade Organization, and spoke against it and sort of contested these tariffs, but still those tariffs were imposed. By 2020, this trade war had impacted the global order. It had impacted India deeply. Almost 95% of the exports going out of India were impacted by the trade war. So it was a big event. Now this trade war is happening again. In 2025, after Donald Trump got elected, in the first 2 days itself, around $180 billion were wiped out from the India market because of the fears of this trade war. On the first day of his presidency itself, Donald Trump imposed 25% tariffs on Canada and Mexico, which he subsequently removed or delayed. But he also imposed a 10% tariff on China, which remains. A couple of days later, he put out 25% tariffs again on steel and aluminium, which caused a drawdown in the Indian market, which was seeing a slow recovery. China has put out retaliatory tariffs. They've imposed 10 to 15% tariffs against the United States. And us, India, we are again caught up in this trade war, seeing the implications of the impact happening on the global trade. Now, obviously, we are not going to see the exact same scenario as last time. A lot of things have evolved, but there are a few similarities as well. These two trade wars differ on the magnitude. In 2018, they were only imposing tariffs on steel and aluminium, but right now, Donald Trump wants to impose tariffs on everything. So this could be a slightly more escalated trade war. Secondly, China had targeted retaliatory strikes at that point in time, but even right now, China is doing a retaliation on a broad set of goods. Finally, in terms of global impact, the previous trade wars slowed down global growth. It reduced manufacturing and trade across the world, and this situation could also have similar impacts. So what are the impacts of a trade war on the global markets? So what Donald Trump wants to do in the short term is to do the America First policies, get better prices for the exports exports going out from the United States, prioritize domestic goods, and also they want to narrow down their trade deficit. America has a ballooning debt, which they've been printing a lot of money, and now with the Doge and this tariff wars, they're trying to reduce the deficit, and this is a way to do it. In the long term, they want to sort of boost manufacturing in the United States and also bring employment back. They want to reduce China's influence on the world, and also they want to prioritize their strategic industries. But trade wars are not a cakewalk. Whenever there's a tariff being imposed and trade being disrupted, it makes the consumer pay more for the same goods and services, because now the prices would be hiked due to the tariffs. The consumer is actually paying more. So the revenue goes from the consumer to the producer, and there is a sense of social loss across the economy. The trade wars also cause escalation in currencies along with commodity prices, and that also impacts different geographies. Obviously, tariffs make domestic goods more attractive to domestic buyers, and they boost domestic industry, so they do have a positive impact on the domestic segment. But on the other hand, the global markets are definitely disrupted. Last time when Donald Trump had imposed these tariffs, we saw that the manufacturing across the globe was impacted. The growth of manufacturing sort of saw a decline after these tariffs were imposed. Inflation spiked up across different geographies, and also the exports across the world reduced due to these trade wars. There was a sentimental hit on manufacturing, sentimental hit on the markets. You saw markets correct by 10% across the world. The currencies across the world also inflated. There was a slowdown in economic growth as well. If we look at the India market, what you would see is that during that period from 2018 June till 2020 January, Indian market went through a volatile phase. There was no straight path of growth, right? There was a lot of volatility from which we came out and saw a strong growth post-COVID. But while the trade war was going, there was a lot of volatility in the market. What is interesting is that during that time, the large caps did much better than small and mid caps. The large caps were also volatile, but they ended up doing better than the small and mid cap segment. And gold was in high demand, and gold actually was the better performing commodity compared to equities. And the ranking was very clear. The largest stock did the best, followed by the next 100, next 200, next 500, and so on. There was a lot of foreign flow that shifted because of this trade war. In 2018, we saw a lot of money flow out of India due to this uncertainty. In 2019, we saw some of the money come back as the situation got clearer. And 2020, obviously, post-COVID, we saw a lot of money come back to India as there was surplus liquidity created in the system. If you're looking at the types of stocks, we look at different NSE indices which follow factors. These are not the factors that we follow. But in terms of factors that the NSE publishes, what we saw was that during that time, your high quality companies and low volatility companies, so essentially the safer sort of companies, ended up doing better than the high beta or high risk names. So that was not the time where high valuations or high risk was being rewarded, because there was a lot of uncertainty and lesser liquidity. If you compare India with other emerging markets, we saw India do better than China because China was imposed with much higher tariffs, and other emerging markets like Southeast Asia or Brazil also saw inflow similar to the Indian market. Now let's quickly try to understand which sectors were attractive during that period. Obviously, we understood that larger and high quality names will be much more attractive as these tariffs increase. But what sectors actually gained during this period? So one of the sectors that gained a lot was the electronic manufacturing and consumer goods space. Because China was facing tariffs, Indian manufacturers were incentivized to create more electronic goods and capital goods, which became attractive, and that industry took off during the trade war. Secondly, even our IT services, because China is a big tech nation, and as tariffs were imposed there, Indian IT became attractive, and we saw the IT sector actually outperform during that period. During that period, the pharma sector did not do well. The pharma sector struggled because we depend on a lot of imports and exports of pharma goods with the US and with other geographies. This trade was really impacted, and the pharma sector sort of struggled during that point in time. Metals and commodities commodities were impacted, and there was a lot of volatility in these prices, even though energy and oil and gas ended up doing better than other commodities. Finally, manufacturing and electronic manufacturing sort of got a boost, and that industry is now taking off. On the other hand, auto sector was very gravely impacted. It was not just because of growth slowdown. There was a consumer sentiment that was hit. At that point in time, we were also facing an NBFC crisis. NBFCs were struggling at that point in time. A lot of reforms had to be done by the government to get that sector going. So due to that, the auto sector actually struggled during that point in time. Finally, agriculture sector gained because, for some of the commodities that were where the tariffs was imposed, India was an exporter and we gained during that time. Along the same lines, on the chemical front also, we did better at that point in time. Finally, on banking and financial services, we saw both of these sectors actually do well. Banks, NBFCs, and different financial services outperformed the market during that point in time, possibly because the rates across the world were still low. They were not hiked at that point in time. Money was flowing out of China and people were seeing some demand in the banking and financial segment in India. So that was broadly about the sectors, and that gives us a sense that we have to find out sectors that either will be immune to all this volatility because we are seeing a strong economic demand in India, and we've done a video about that where we've identified the key growth segments in India, for example, hospitals, electronic manufacturing, capital markets, chemicals, etc. Or you have to find out those sectors which stand to gain because of tariffs being imposed on other geographies. So that would be the strategy that could work as this tariff regime continues. Let's quickly understand what was the impact on the macroeconomics. Supply chains were disrupted, volatility increased in the market, and that actually led to growth slow down across the board. India, which has close to 8.3% real growth in 2017-18, saw the growth slow down to 4.2%, right? So the trade war did cause some stress, but during that time, India was also going through an NBFC crisis, which escalated the slowdown. Today's situation might be very different from what happened at that point in time. There was a different impact on the trade balance and export growth also. Initially, we saw our exports grow because China was tariffed against, but eventually we saw our exports actually slow down because the global demand also slowed down. Our deficits were under control because the commodity prices and the crude prices reduced, which India is highly susceptible to. During that period, rupee depreciated by 10%, so it did have a big impact on the rupee. And as the cost of foreign goods, oil prices, and even food prices in India hiked, we saw inflation also increase during that period. The RBI managed it by cutting rates at multiple points in time, but inflation still remained a challenge at that point in time. Now, obviously, this was a tough period in the market. Many of us saw that firsthand. And this time again, the market is pricing in that fear. What we have to understand is that the market is a second order chaotic system. What that means is that when you expect something to happen, people start trading on it immediately, right? So let's say we expect Donald Trump to do something a year out or 2 years out, we'll start pricing that in before that event can happen. So this is already happening. I think a lot of the pain that is going to occur is priced into our market, but we might see the volatility sort of continue. We expect short-term recoveries from the levels that we are. That is not to say that there might be other periods of pain that happen during that point in time. So while we've all been very excited about opportunities of the India growth story, there's a bigger picture that is forming in the world that is impacting our market. And it is extremely crucial that as investors, that we start looking at this particular topic also very closely. So this was our short video on the trade war. We wanted to educate our investors on understanding this global phenomena, how it can impact our country and our industries, and how they can reposition their portfolios. If you like this video, please do hit the like button, subscribe to our channel, share it across with your friends. And if you would like us to make videos on any other topic that seem interesting to you, write down in the comments what you would like us to talk about next. So best of luck in this volatile period in the market, and happy investing.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.